So as the last leg to the session, I would like to welcome Mr. Vinod Kothari, partner, Vinod Kothari and Company. He shall be sharing his thoughts on amendments brought in by Finance Bill in corporate and financial laws. Mr. Kothari is a renowned company law expert, having practiced for 33 years and has been associated with Ramayya's Company Law as its specialist editor. He has also authored several books published by Taxmann. Welcome on board, sir.
Very good evening, Ridhima, and thank you all for giving me the opportunity of being with you today. This is aptly labeled the budget marathon, and like in every marathon, I think those who are staying for the longest are the winners, and I'm therefore thanking all of you for staying back so long throughout the day. Almost 8-9 hours of massive inputs by different speakers. Of course, most illustrious speakers, but I think the real compliments go to the audience who have been still staying back through this very, very long set of innings. Now, what I'm going to do, and I'm hoping that this would do justice to your endurance throughout the day, is to very briefly give some overview of what has happened, what's about to happen in financial and corporate laws. As I'm sure you can imagine, the budget does not give full details of what is going to happen. It sort of gives a kind of curtain raiser on some of the important measures the country would see in the next few months in the financial and corporate law space. I would therefore be quickly focusing on at least two of the important changes. Number one, the introduction of CBDC, central bank digital currencies. And number two, the reforms in ease of doing business in terms of permitting businesses to exit by way of a voluntary exit exercise. And of course, some reforms in insolvency law as well, which also seems to be on the anvil, as the Insolvency Bankruptcy Board of India has released consultation paper on some changes last week itself. Now, to give a very quick idea about some of the changes the finance minister talked about in financial and corporate law space, very briefly, I think some of these would have been talked about during the day. I was listening to the last speaker talking about SEZ changes. The tax on virtual digital assets was discussed at length during the day as well. So I'll not be sort of overlapping on that. And I'll be straight focusing on issue of digital currency, which is by the central government, therefore central bank digital currencies. I will briefly say that the government is also proposing an important change in CGT MSE, central government guarantee for lending to MSEs, central government guarantee for MSEs, which is CGT MSE scheme. This scheme, which is currently guaranteeing the MSME lending of banks and NBFCs, will have a further infusion of funds so as to allow an extension of guarantees to the tune of rupees 2 lakh crores. 2 lakh crores, of course, is not the capital that the government would be inserting. Typically, CGS, credit guarantee scheme, typically works on leverage of 8 to 10 times. And this guarantee, I guess, will be extended over a period of time. So it's not like the government is parking 2 lakh crores right away, but there will be some extension of capability of CGT MSE as well. Besides, there is a scheme currently going on called Emergency Credit Line, ECLGS, Emergency Credit Line Guarantee Scheme, which provides for the government guarantee for a 20% additional funding that banks and NBFCs can do. This was launched in wake of the COVID crisis, and the government has extended the validity of this to 31st March 2023 with the additional period focused on the hospitality and certain specific sectors as well. These are matters for which details are still expected, so we wouldn't know that as of now. Now, the government, of course, has talked about ease of doing business 2.0, and it talks about definitive laws to amend the insolvency laws and to reduce the time to be taken in voluntary winding up, which is something that I'll discuss at length as I discuss later. And the government, of course, has talked about central bank digital currencies. Now, central bank digital currency is quite an important topic, and I'm sure you would have seen the massive reaction that it had throughout the country. And this topic has attracted a lot of attention. Some people thought Modi ji वापस demonetization लेके आ रहे हैं क्या? It's maybe an idea of demonetization once again. Some people might have thought कि क्या होगा future में, will all money go to the government and therefore the government would know किसके पास कितना पैसा है. So people have had different reactions to the proposal to introduce CBDCs. However, I'm sure this development and the government has announced definitive plans of launching it during financial year 2023. It's a very significant development for the country. And I would say, number one, that India will be joining the league of a lot of central banks which currently are on this project already. India seems to be launching in 22-23, which means India would probably launch what is called a pilot stage very soon, and thereafter probably would launch it in an official sort of implementable way. But at the same time, the introduction of CBDCs also clears at least two very important issues. Number one, the fact that cryptocurrencies, private cryptocurrencies, and I'm sure all of you would realize that so much is happening in the private cryptocurrency field. Youngsters, 20-something, are sort of massively investing into private cryptocurrencies, which is seen a sort of ping pong kind of movement over the last few months, values going up and down tremendously. Number one, the sort of fear or the apprehension that the government would be banning private cryptocurrencies altogether, that fear seems to have partly been, or at least substantially been, addressed. It seems that with the introduction of tax on virtual digital assets, private cryptocurrencies will probably coexist with central bank digital currencies. Whether with the introduction of central bank digital currencies, CBDC for short, will private cryptocurrencies still have a relevance? That's a question to be left to be examined later. But it seems that CBDCs will coexist with private cryptos too. That's one very important change, or one very important signal. The second very important signal is the government is all in favor of digital payment systems. India has made some significant progress in digitalizing the payment systems across the country, and the country would therefore continue to make further progress into this space, which is, I would also say, assisted by the introduction of CBDCs, which is proposed by the finance minister. Now, first, when you talk about CBDCs, a question that comes, are we the only ones doing it? And I'm sure it's a matter of common knowledge for most of you, but I would still share some data to share. Roughly 80%, it's a massive number, 80% of the world's central banks are currently into some stage or the other of introduction of CBDCs. It's not something that we're doing new. India already has launched the so-called research phase. Research phase is going on currently. So these 61 countries that we notice here, which have the research phase, that includes India too. And in addition, there are several countries which have actually gone to the so-called pilot phase too. So you can see the world graph over there shows the countries which are in research phase, which is most of the world. There are some countries which are still in proof of concept stage, and some countries have gone further and launched the so-called private pilot phase. And I'm sure, interesting, you can see China is over there. So China has already launched the pilot introduction phase. And interestingly, the government of China has sort of been paying the lottery winnings in form of e-currency, ECNY, that's the name. So lottery winnings are being paid. So some 50,000 lottery winners have been paid in form of e-currency. And data recently also suggested that about 95% of that money has already been spent. In addition, some other countries have also into the pilot phase currently. Some countries say that they launched it. I, of course, cannot completely vindicate those claims. For example, Nigerian central bank has said that it has launched e-Naira. I have some connects in Nigeria, but I'm not exactly sort of confident of vindicating the statement. Other countries, for example, Bahamas, is not economically greatly relevant country. So the point I'm trying to say that a lot of countries world over are currently in different phases of launching CBDCs. Now, let's first understand in what way does a CBDC differ from a currency. Now, what you have in a wallet, the physical cash, that's currency. What exactly makes it currency? What's legal tender? What's money? What's currency? And what does physical currency actually mean? So legal tender, which is what we use in legal parlance, is something which can be legally used as a mode of settlement of transactions. If I need to pay 1,000 rupees to somebody and I offer him 2 notes of 500 rupees each, that's a legal tender. The person cannot decline that I will not take this money. If I were to pay in 1,000 coins of rupees 1 each, that also cannot decline because a coin is also a legal tender. But if I hand him a check of 1,000 rupees, he would probably say that this is not something that I'm willing to accept. I wouldn't take your check. He is not bound to take it. If I pay him by credit card as well, he has his right to say that I don't accept credit card payment. So that would mean credit card is not a legal tender. Currency is legal tender. coins are legal tender. Now, what does currency actually mean? A currency actually is a claim on the central bank. All currencies are claims on the sovereign for central bank. I'm sure this is something that you notice on every currency note. It says the governor promises to pay the value of rupees 10 or rupees 100, whatever the denomination of the currency note be. You'd find this little thing on the currency note, and if you sort of zoom it and read it, it says I promise to pay the holder thereof the value of the amount of the currency note. And therefore, when the RBI issues currency note, what therefore happens on the balance sheet of RBI, the RBI has an equal amount of liability. You can see on the graph over there, we have the notes issued by the RBI showing as a part of the liability on the RBI's balance sheet. The RBI, of course, when it prints currency notes, it has a liability, it has an equal amount of assets as well, and it uses that assets by infusing the money into the financial system, which is what we say the government is printing currency notes and infusing money, which might have implications in terms of inflationary pressures as well. Now, that's not our point here. Our point is, what was the need for introduction of CBDCs in India currently? Now, there are few factors which sort of underscore the need for CBDCs currently. Number one, that in India, the extent of wealth or extent of assets held in the form of cash is quite high. This number, that is the currency to GDP ratio, in India is currently showing approximately 14.5%. Of course, this number has been impacted by the pandemic. And I'm sure all of you realize that during the pandemic, people stored cash because people were sort of wary that they might need cash any point of time. So a lot of people went into cash form of holding assets. But 14.5% is a substantial number. Japan is another country which has a very high currency to GDP ratio, but that's, I think, obviously explained by the fact that Japan has negative interest rates. So if people store their wealth in banks, they'll end up paying money. If they store it physically, I mean, the money is still with them. In India, despite interest rates being good, still people tend to store a lot of money in cash form. So number one, we love currencies. India as a country, Indians as people, we love currency notes. Of course, over a period of time, the extent of digital payments has substantially gone up. Now, currently, I'm sure I don't need to say that. Go to the remotest part of the country and go to the smallest shop. They're still willing to take payments by one of the payment devices. They can accept a Beam payment or Paytm payment, or they can probably take Google Pay. That's something which is sort of traversed the entire length and width of the country. Everywhere currently, digital payments are easily accepted, easily possible. And you can therefore see that this graph, which is showing the extent of digital payments, this is coming from the economic survey released the day before the budget, and shows a very sharp rise in the penetration of digital payments in the country. So remember a few things. Number one, that we as a country, we love currencies. At the same time, the extent of digital payments has actually gone up significantly. I would also take the case forward. Now, even though we know that the extent of digital payments actually grown, however, digital payments don't come cheap. Digital payments have a significant cost. For example, if you're paying by credit cards, the merchant is paying a merchant commission to the credit card issuing bank. In addition, between the date that your bank account is debited and the date on which the merchant's account is credited, there's a substantial lag of time as well. So number one, there is an interest cost inbuilt. Number two, there is a cost in terms of merchant fees. Now, you don't get to see, because for you, if you have to pay, let's say somebody 5,000 rupees and you pay 5,000 rupees by card, you're paying the same amount. But inherently, there's a cost on the transaction, and that cost is some way or the other is passed on to the consumer. So the consumer, the transaction is bearing the cost of indirect, the indirect costs on the transaction are ultimately being passed on to the consumer. You can see this data which is coming from the BIS, that the cost of various modes of payments, for example, in case of cash, the cost is basically what? The cost of handling cash. Currently, I think many banks are, if you make payments substantially by cash, banks will impose handling charges. Because cash handling is also a costly affair. So there are costs in terms of cash payments. There are costs in case of debit cards. There are costs in case of credit cards. UPI, etc., are a little cheaper, but they still involve cash because there is a bank account behind it. So digital payments, while they mean the substantial convenience to consumers, but they still are not free from costs. Now that brings us to the case for digital currencies. Now let's understand that monetary system in every country is a public good. It's a sort of public utility. And it's the obligation of the sovereign to facilitate the currency system. Currencies are the very, I would say, sustenance of all economic activities. Currencies are the mode in which people express or people store or measure their assets. Currencies have a transactional use. Currencies have a storage use as well. So like people mostly say, money is a matter of functions for medium, measure, standard, and store. Money is a matter of functions for medium, becomes medium of exchange, measure. How do you measure, for example, what is the cost of this cell phone versus the cost of any other cell phone? We measure it in terms of money. Medium, measure. Standard, money is also a measure of standard. That's a standard expression. And of course, it's a mode of storing money. Now, that's how money is, but the forms of transactional use of money has evolved over time, and that's actually evolved with advancement of technology. For example, recall, let's say 500 years back, it might probably been hundis or bills of exchange by merchants, which might have been used for settling payments. Then came checks, and checks were extensively used because checks were backed by an interbank clearing system. And I'm sure this is something that you would probably recall that 10 years back, when you made a payment by check, you'd probably say, bank wala bolta tha, check aapka clearing mein gaya hai. And the banker would collect all the checks and go to a clearing house where different officers of different banks will meet together and they'll sort of clear their mutual obligation, clearing and settlement process. Then came RTGS, real-time gross settlement, and NEFTs. As technology became more invasive and technology became more fast, modes of payment have continued to become faster as well, RTGS. And then came the so-called fast payment systems, generically called fast payment systems. And in India, we got a name called UPI, which is a unique payment interface. And that's something which made things even faster, because as you make a payment today, your mobile can be used as a UPI device. My bank account is connected with my mobile number. Your bank account is connected with your mobile number. I can make a payment from my mobile number. It straight goes into your bank, and from my bank account to your bank account, using the mobile phone as the connecting device. So this is how payments have evolved over time. Now, digital currencies, the reason for digital currencies to still hold the appeal is that while each of these modes of payment will require the presence of some intermediary. For example, even when I'm making a payment using my mobile device, it's linked with a bank account. So there is a money lying in the bank account. If I'm making a payment through a debit card, I'm still using the money in the bank account. If I'm making use of a credit card, I'm using the credit facility granted by a bank. So credit card, debit card, buy now, pay later, UPI, Bheem, or Google Pay, or any device, eventually the money is going from my bank account into the Pay's bank account. And therefore, there is an intermediation nevertheless. Financial intermediation is still the backbone of all payment systems. Digital currencies try to sort of eliminate financial intermediaries by saying that the currency is straight issued by the central bank itself. Like the currency note that I use today is obligation of central bank. Similarly, CBDC is a digital form of a currency note. I probably would not need 50 rupees or 500 rupees or 1000 rupees, because the moment the money is in digital form, I can probably have 555, I can probably have 667. I don't need to have in particular denominations, because the denomination will become irrelevant. Like in case of shares, when shares become dematted, the face value, the number of shares, or so-called marketing lot become irrelevant. Similarly, in CBDCs, the denomination of a currency note will become irrelevant. I can, for example, have 1,08,555 rupees without saying how much, in how many denominations is this money broken. But eventually, the CBDC is a claim on the central government. And therefore, like I can make a payment to somebody using currency note, which is not involving a financial intermediary, which is not involving a bank, because I'm still paying by a note which is obligation of central bank to the recipient, who's also getting a claim on central bank. So if I imagine, if instead of having a bank account in State Bank of India or any of the banks, I had a bank account with let's say Reserve Bank of India, and the RBI was to credit my bank account with the amount of money that I give to them, and I use my amount lying with RBI to make payments to whoever I want to make payments to. So imagine the system where crores and crores of people all have direct bank accounts with Reserve Bank of India, and the RBI in turn gives this gives, let's say, certificate of that money lying with the RBI in form of digital currency. There we have CBDC. So CBDC, being a direct claim on the sovereign, has several benefits. Number one, it's of course liquidity. It's ultimate acceptable because it's nothing but legal tender. So it's perfectly liquid. It's got tremendous integrity because there's no question of failure of that system. Banks which have my account, banks could fail. There have been questions of failures of banks. There is a settlement risk as well, because ultimately when I'm making payment from a bank account, my banker is supposed to make payment to the recipient's banker. There is a question of settlement between my banker to the recipient's banker. In case of CBDCs, the whole question becomes completely irrelevant. The second reason for introducing CBDCs at this stage is the tremendous growth in private cryptocurrencies. In absence of a central banking alternative, private cryptocurrencies, the bitcoins of the world, they've been sort of holding the field, and central banking regulators consistently and vociferously are holding the view that cryptocurrencies are speculative assets. You can see the statement from the BIS annual report, which says by now it's clear that cryptocurrencies are speculative assets rather than money. It's a speculative asset rather than money, and in many cases they are used to facilitate money laundering, ransomware attacks, and other financial crimes. So the use of cryptos in illicit or sort of clandestine payments is observed by the Bank for International Settlements. With all these allegations, nevertheless, I mean, because it's fancied by the younger generation, the so-called millennials, the use of private cryptocurrencies has tremendously increased. You can see the data. My talk today is not on private cryptocurrencies. I'll not therefore talk further on that. There is a sort of improvisation in form of what is called stable coin, which is a crypto but backed by a fiat currency. For example, in this case, backed by US dollars. So stable coins are not speculative because they're fully backed by a fiat currency. But there again, there are questions of governance because you never know who is the issuer of such stable coins. Now let's compare traditional money, private cryptocurrencies, and central bank digital currencies to set the background for introduction of CBDCs. The format of traditional money, the currency note, is of course physical. Private cryptocurrencies are virtual, and CBDC of course will come in digital format. Issuer of currency note, central bank. Private cryptos, there are private entities. I'm told data suggests there are some 17,000, mind-boggling number, 17,000 variants of private cryptocurrencies floating in different parts of the world. And also the astounding data is that roughly 10 crores of the holders of private cryptos are from India. I don't know what is the veracity of this statement, but this is a statement from one of the websites which tracks private cryptos, saying 10 crores Indians are holding private cryptos currently. Huge number, I would say. And so the issuer is private entities. In case of CBDC, the issuers central bank itself. The technology doesn't arise in case of physical currency. In case of private cryptos, it's mostly blockchain, digital distributed ledger technology. In case of CBDCs, it could be DLT or could be a centralized ledger. In other words, the ledgers may not be distributed across various computers. It could be a centralized computer as well. Use of blockchain. In case of private cryptos, that's a private blockchain. In case of CBDCs, it could be either a permissionless public blockchain technology or could be a so-called permissioned DLT, which means specific DLT users or DLT authenticated sources have been permitted by central bank to make use of the DLT technology. The governance in case of currency notes is centralized. In case of CBDC, also equally centralized. In case of private cryptos, of course, is decentralized. And that's what raises questions of governance. Backed by, in case of traditional money, domestic monetary reserves. Same in case of CBDCs, backed by domestic monetary reserves. I'm sure all of you understand that Indian currency is backed partly by gold and partly now, because there used to be a full gold standard long years back, which is now a partial sort of limited gold standard. And the way the CBDCs currency notes are routed through commercial banks, CBDCs may either be issued directly by the central bank itself or may be routed through intermediaries. There are multiple models being tested by countries. It's not necessarily that CBDCs will be issued by RBI directly to individuals. There are a variety of models. I'll make a very quick reference of these models, but I do guess that it's quite late in the day and you may not probably be wanting a whole lot of burdened details at this point of time. Accessibility to by the issuers and by authorized persons. And of course, the claim is on the central bank. Now, there are some downsides of cryptocurrencies too, and that's something to need to understand. In terms of upside, very easy. It's a claim on the sovereign, ease of settlement, no intermediation, no settlement risk, least transaction cost. Transaction cost will be the same as in case of money. रुपया रखने में फिर भी कॉस्ट है, रिस्क है, सिक्योरिटी इश्यू है. CBDC में वो भी इश्यू नहीं है because the money becomes digital, so your password or your token will control it. Your public key and private key will control it. So easier to store, less chance of fraud, risk, fraud, technology fraud will still remain. Identity fraud will remain. But let's say the risk of stealth, risk of robbery, those risks will go away. Convenience in cross-border payments as well. You don't need to sort of, if you want to, let's say, travel from India to US, you don't need to carry dollars. You can take your digital currency. And the cross-border convertibility also between central banks is a matter being discussed currently as to how central banks can ensure cross-border convertibility as well. But there are some downsides, and important to understand the downsides. Particularly when CBDC announcement was made in the budget, you would have probably seen there was some reaction in terms of prices of banking shares. So quickly understand why that's happening. Because currently, a lot of money in the banking system is because of the transactional, what do you call it, transactional deposit. For example, if I'm issuing a check today to somebody, I need to ensure that my bank account has equal amount of money. Otherwise, my check will get bounced. So for the purpose of ensuring financial transactions, money is kept typically in current accounts. The so-called CASA accounts or current accounts with banks are mostly for transaction purposes. If the use of CBDC becomes massive, I would not need the CASA account at all, because I wouldn't be using checks, so I wouldn't need money to lie in current accounts. So substantial amount of money which is currently in banking system in the current accounts, all of that will become irrelevant. Now, that becoming irrelevant, that would mean the major money with which banks sort of thrive on, but that's zero cost money with the banks. And banks also do what is called credit creation with that money. So the use of CASA money by banks will become irrelevant, and therefore there will be a substantial flight of money from the banking system into the financial system though, but banks will not be able to use the zero cost money anymore, and therefore the cost of funds in the hands of banks might increase. Number two, runs on banks might also increase. If at all there's an adverse news on any bank, it would be easy for people to withdraw money from the banking system because they're all in digital format. Risk of cyber attacks, with all matters which the moment we have more digital payments, there's a possibility of digital frauds as well. And then similarly, risk of identity thefts as well. The other big risk is risk of personal data, because crores and crores of people, the personal data would be captured by some system somewhere. So this data could be subject to hacking or some kind of inroads or encroachment into personal data. That's a big risk. Now, amendment has already been proposed to be made in the RBI Act to permit RBI to issue digital currencies. There might be some incidental amendments required in some other laws as well, which I guess as and when we come to that might be made. I don't think I'll be discussing further on the models of CBDCs, but quickly to say that CBDCs can have a wholesale model, can have a retail model. Wholesale model meaning transactions in the financial system itself, bank to bank or bank to NBFCs. Those payments can happen in digital mode. Rest of the public will continue to deal with existing financial systems. So interbank settlements will be facilitated by use of CBDCs. That's one possibility. And then in case the RBI goes for a retail model, there are multiple options. For example, single tier retail CBDC would mean the public has direct access to an account with central bank. So if A wants to make a payment to B, it's a direct debit and credit in an account maintained by central bank itself. All data, all accounts are maintained by central bank itself. That's so-called non-intermediated or a single tier straight retail system. There could be an intermediated CBDC system as well, where the government brings in financial system providers or payment system providers PSPs or payment system providers in between, which act as sort of intermediaries between central bank and the holders of the currency. Like we currently use banks today, you'll probably have payment system providers being used in a two-tier system. And there might be hybrid system where it's possible to have direct access to central bank as also to make a payment through the intermediaries. Does it necessarily mean that we will necessarily have to depend on distributed ledger technology? Like I mentioned earlier, it need not be DLT, it might be a centralized ledger technology as well. Will data anonymity, how do you ensure that the data as to how much wealth am I holding currently? One of the downside which everyone is apprehending is that if I go for digital currency, what is my current holding of wealth can at any moment, at any point of time be known to RBI. And through the RBI, it might be known to whoever might want to know. My tax officer, for example, might know what is my wealth without having to do anything. He just goes to RBI website and gets my wealth information. To that, there is an option because there are two options being thought of. CBDCs may be used in an account form, which means account with RBI, or in token form. If you want to talk about token, a sort of, let's say, a fungible token form, in that case, the token is anonymous because token is almost like currency note and can continue to trade without any trail with the RBI. Aware of the time limit and aware of the fact that you all have had a marathon session, I'll quickly pass through. I'll do a fast track movement to the fast track exit. And very quickly, the government is proposing to do a sort of speeding up of the exercise that is currently used by what is called Section 248/2. 248/2 of the Companies Act is a fast track exit mode. Now, basically, the use of this section is that if a company has become virtually defunct, the company has no assets, no liabilities. Assets have been used to pay off liabilities. Now there is nothing in the company. The company is almost like a waste piece of paper. So I can go to the ROC and say, strike off the name of the company because the company is nothing but a waste piece of paper. Just throw it in the garbage. So 248/1 is strike off action by the registrar of companies. 248/2 is voluntary strike off by the company itself. As opposed to this, we have a process of Section 59 of Insolvency Bankruptcy Code, which is voluntary liquidation of company. That's a process which is elaborate because the company has assets which need to be sold off, the company's liabilities which need to be paid off, and then the remaining money, the excess of assets over liabilities, needs to be distributed to the shareholders. In a so-called fast track process, there is no question of distribution of money to shareholders because there is no asset or liability which actually needs to be taken care of. The company is a sort of void or empty company. It's become a sort of, as I said, scrap. And all I need to do is to kind of take it through the process of dissolution. So that's what 248/2 is. Now, the observation which the government makes is that though the process is seemingly simple, but it's taking long time. There are, for example, cases which are lying for more than 1,000 days, cases lying for more than almost like 3 years. Now, the government wants to speed up this process and set up a new sort of portal which will permit a fast track exit of companies through a virtual automated process. Now, if you were to compare the modes of exit today, because ease of exit is very important part of ease of doing business, the modes of exit currently include number one, strike off, like I mentioned, voluntary liquidation, which is Section 59 of IBC, mergers and amalgamation, that's also a mode of exit, or a compulsory liquidation under the Companies Act. The strike off process is completely non-judicial. It has no involvement of judiciary at all. Voluntary liquidation is partly judiciary because currently we still have to go to NCLT at the ultimate stage of liquidation. Mergers are even more NCLT driven because there are at least 3 stages that the matter has to go to NCLT. Compulsory liquidation under the Companies Act happens completely under the eyes of the court. So it's highly, I would say, adjudicative in nature. And in terms of comparing those different modes of striking off versus merger versus summary liquidation, etc., I got a tabular comparison, but well, I'm aware that it's quite a long discussion throughout the day, so I wouldn't maybe take your time on that. And I would quickly therefore say that in terms of reforms of Insolvency Bankruptcy Code as well, the voluntary liquidation process, which is supposed to be fast, currently, however, the process is hardly fast because data reveals that currently a whole lot of cases are still taking long time. A whole lot of cases are taking long time, and you can probably see that even though the process is completely voluntary, but some cases are lying there for almost like more than 2 years. 177 cases lying for more than 2 years. More than 2 years might actually be more than 4 years as well. So as a practitioner, as somebody having a real life experience, I could probably say that this is something which is partly owing to the substantial delays that happen at NCLTs. Everyone else has a sense of time. Judiciaries and courts in India don't have a sense of time. Somehow they have no compulsion to, sort of handle matters fast. They probably have no disincentive to delaying matters and no incentive to moving matters fast. So if at all a reform is needed, in my view, reform is most needed at the level of adjudicating bodies. Now, last point very quickly, cross-border insolvency. That's another reform and insolvency law. And what is proposed to be done there is that India implements the so-called UNCITRAL model law and makes sure that UNCITRAL principles are applicable to India as well. A working group of MCA has recently submitted a report. That report has come in phases. One phase is already there in public domain. Another report will probably be out soon. And thereafter, India will implement the cross-border insolvency principles. The meaning of which would be that if an Indian company has set up or has got assets abroad, and there are plenty of cases, I don't need to talk about names there, Indian entities which are sitting with assets abroad, we can use the insolvency law of that country to attack the assets or seize the assets in that country. So that would be, I would say, welcome move for this country, because there are a whole lot of defaulters of India who sort of disappear into various places in the globe. And if India has a cross-border insolvency law with that country, aligned with that country, we can actually capture the assets sitting in those jurisdictions. I think with these few thoughts, I would once again say you've been so very patient, so very tolerant, and you've been here throughout the day. So thank you all for being so patient and being an audience today. You're wonderful. And thank you, Taxmann, for giving me this opportunity.
Thank you so much, sir, for a comprehensive and a thorough session, ending the marathon at the absolute correct note. Thank you so much, sir. So with this, I think we all had a insightful and a very informative day. So with this, I will quickly take the opportunity to thank all our speakers, Mr. Mukesh Patel, Mr. Gaurav Jain, Dr. Punya, Mr. Raghav Bajaj, Dr. Manoj Fugla, Mr. Suresh Kumar Kejriwal, Ms. Aarti Raute, Mr. Amit Rana, Mr. Gaurav Singhal, Mr. Sandeep Junjunwala, Mr. Ranya Lakshmi Kumaran, and Mr. Kothari. Thanks a lot to everyone for taking time out from the packed schedule and sharing their finest thoughts and analysis with us. Also, a token of thanks to all our attendees today for making this marathon a success. To conclude, in the words of Bill Gates, power comes not from the knowledge kept, but from the knowledge shared. Thanks a lot, everyone.